The year was 2008. It was a time when the world seemed to be on a steady path, with economies growing and optimism in the air. But beneath this veneer of stability, trouble was brewing. The world watched in disbelief as the American economy teetered on the brink of collapse. Financial markets were in turmoil, and the once unshakable confidence in the system was rapidly eroding. What went wrong? It all started with a housing bubble, a seemingly unstoppable rise in house prices. For years, home values had been climbing, and people believed they would continue to do so indefinitely. Like a house of cards, it looked strong from a distance, but the foundation was built on shaky ground. The housing market was propped up by risky loans and speculative investments. This wasn't just about bad mortgages or irresponsible borrowers. It was a complex web of financial instruments and high-stakes gambling by banks and investors. This was about a system where Wall Street greed met government oversight that was about as effective as a chocolate fireguard. Regulatory bodies failed to keep up with the rapid innovations in financial products. The American dream, once symbolized by a white picket fence and a two-car garage, had morphed into a nightmare of foreclosure signs and shattered lives. Families were uprooted and communities were left in disarray. The ripple effects were felt far and wide. Businesses closed, jobs were lost, and the sense of security that many had taken for granted was shattered. The calm before the storm had given way to a full-blown economic crisis. In the late 1990s and early 2000s, America was riding high. The economy was booming and optimism was in the air. People were celebrating newfound opportunities, and the American dream seemed more attainable than ever. The stock market was soaring and consumer confidence was at an all-time high. The dot-com bubble had burst, but the Federal Reserve, keen to keep the good times rolling, lowered interest rates. Alan Greenspan, the then chairman, believed that by making borrowing cheaper, the economy could be kept afloat. This move was intended to stimulate spending and investment, ensuring that the economic momentum wasn't lost. Suddenly, borrowing money was cheaper than ever. Banks and financial institutions were eager to lend, and people were just as eager to borrow. Loans were being approved left and right, and it seemed like everyone was taking advantage of the low interest rates. From personal loans to business loans, the credit market was flooded with opportunities. This, coupled with government policies promoting home ownership, created a perfect storm. The government was pushing the idea that owning a home was a key part of the American dream. Programs and incentives were introduced to make home ownership more accessible to a broader segment of the population. New housing developments sprang up across the country, and the dream of owning a home seemed within reach for many. People who could never have dreamt of owning a home before were being approved for mortgages. First-time home buyers were celebrating their newfound status as homeowners. Mortgage approval documents were being signed at a record pace, and families were moving into their new homes with a sense of pride and accomplishment. Demand for houses skyrocketed, and with it, prices soared. The problem? The rapid increase in demand led to a housing market frenzy. Real estate agents were showing houses to eager buyers, and news reports highlighted the rising home prices. It was a seller's market, and competition for homes was fierce. Many of these new homeowners were stretching their finances to the limit. They were taking on more debt than they could comfortably manage, hoping that their financial situation would improve over time. Families were sitting at their kitchen tables, reviewing their budgets, and worrying about how they would make ends meet. They were enticed by low teaser rates that would later adjust, often dramatically increasing their monthly payments. Financial advisors explained the benefits of these adjustable rate mortgages, but many homeowners didn't fully understand the risks. When the teaser rates expired, they were hit with higher mortgage bills, leading to financial strain and uncertainty. Enter the subprime mortgage. These were loans given to borrowers with poor credit histories, low credit scores, or unstable incomes. Lenders, flush with cash and eager to keep the money flowing, threw caution to the wind. They offered no-doc loans, requiring little to no documentation of income or assets. Adjustable rate mortgages with their initial low rates were heavily pushed, even to those who couldn't afford the inevitable rate hikes. It was a recipe for disaster. But Wall Street, blinded by greed, saw an opportunity. They bundled these risky mortgages into complex financial products and sold them off to investors, spreading the risk like a virus. These weren't your grandma's bonds. Wall Street wizards, with their fancy MBAs and even fancier bonuses, created mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These were essentially bundles of thousands of mortgages, sliced and diced and repackaged as low-risk investments. Investors hungry for higher returns snapped them up. Rating agencies, paid handsomely by the same institutions selling these products, slapped AAA ratings on them, the financial equivalent of a gold star. The problem? These complex instruments obscured the true risk. When the housing market inevitably cooled and homeowners began to default on their mortgages, the house of cards began to crumble. Section 5. The bubble inflates. How speculation supersized the market. Adding fuel to the fire were speculators. These weren't families looking for a place to call home. They were investors, big and small, who bought properties with the sole intention of flipping them for a quick profit. They drove prices even higher, creating a frenzy in the market. Builders, eager to capitalize on the boom, overbuilt, flooding the market with more houses than there were buyers. The stage was set for a spectacular crash. Section 6. Bursting the bubble. The party's over and the hangover is brutal. By 2006, the housing market began to cool. Interest rates rose and adjustable rate mortgages reset, sending monthly payments soaring. Homeowners, many of whom were already stretched thin, began to default. Foreclosures skyrocketed, house prices plummeted, the bubble had burst. The consequences were swift and brutal. Millions of Americans lost their homes. Financial institutions saddled with toxic assets teetered on the brink of collapse. Section 7. Global financial meltdown. When America sneezes, the world catches a cold. The crisis quickly spread beyond American borders. Remember those MBS and CDOs? They'd been sold to investors around the world, spreading the contagion far and wide. Banks stopped lending to each other, fearing that their counterparties might collapse. Credit markets froze. Global stock markets plunged. The world was on the brink of a second Great Depression. Section 8. TARP and recovery, band-aids for a broken system. Governments around the world scrambled to contain the crisis. In the United States, Congress passed the Troubled Asset Relief Program, a $700 billion bailout of the financial industry. The Federal Reserve pumped trillions of dollars into the financial system, providing liquidity and preventing a complete meltdown. Slowly, painfully, the global economy began to recover. But the scars of the crisis ran deep. Section 9. Lessons learned. Can we prevent history from repeating? The 2008 financial crisis was a wake-up call. It was a moment that shook the foundations of the global economy, leaving millions without jobs, homes and savings. The ripple effects were felt far and wide, from Wall Street to Main Street and across the oceans to Europe and Asia. It exposed the dangers of unchecked greed, lax regulation, and the complex financial instruments that few truly understood. The crisis revealed how deeply interconnected our financial systems are, and how the failure of one part can lead to the collapse of the whole. The complexity of derivatives and mortgage-backed securities, which were supposed to spread risk, instead concentrated it, leading to catastrophic failures. In the aftermath, governments implemented reforms such as the Dodd-Frank Act in the United States, aimed at preventing a repeat of the crisis. These reforms included stricter regulations on banks, increased transparency in financial transactions, and measures to protect consumers. The goal was to create a more stable and resilient financial system that could withstand future shocks. But the question remains, have we learned our lesson? Only time will tell. While some argue that the reforms have made the financial system safer, others believe that new risks have emerged. The rise of fintech, cryptocurrencies and other innovations present new challenges that regulators are still grappling with. Moreover, the memory of the crisis may fade, leading to complacency and the potential for history to repeat itself. But one thing is certain, the events of 2008 serve as a stark reminder of the interconnectedness of the global economy and the devastating consequences that can result when the pursuit of profit trumps prudence and responsibility. It is a lesson that must not be forgotten, as the stakes are too high. The challenge now is to remain vigilant, to continue to adapt and improve our financial systems, and to ensure that the mistakes of the past are not repeated.